Hey everyone, me Kevin here. So this is going to replace the market closing video for today, and this is my thought on sort of what's going on in the market right now, because we have this continued uncertainty in the market, so much uncertainty about this market, and I don't blame it, because this morning when we did a 5-hour market open live stream in front of the Sacramento Capitol building, so the state of California Capitol building, in this live stream we pulled up this really interesting chart which shows that consumer spending spikes 1 month after every time we have done a stimulus check. $1,200 stimulus check, the $600 stimulus check, and the $1,400 stimulus check. Literally 1 month after every one of those, April last year, January of this year, and March of this year, we saw a big spike in consumer purchases. And it's really interesting because it makes me wonder if this is a K-shaped recovery where basically the rich just got a bunch richer, then is it not possible that the rich aren't really spending that much money other than maybe on things like real estate and stocks? And the only thing really propping up the fundamentals for the companies wealthier people are buying are actually inflated and temporary consumer purchasing numbers. So basically, the rich people get more money. They overpay for assets like real estate and stocks because they're getting richer, and stocks overpaying for stocks because these retail numbers are coming in so great. And the reality is, the retail numbers are only coming in so great because of the stimulus money and all the money printing that's going on. Well, what happens when that well dries up? And that makes me very curious about where we're going for 2022. Because here's the thing. Remember this. Right now we have the $250 and $300 per month child tax credit that started on July 15th. That only lasts 6 months, and then you get the rest on your tax return next year. It's okay, so people get a little boost again. Unemployment runs out in September. By somewhere around March or April of 2022, we're not going to have any more of this funny money. We're probably going to have tapered. We're not going to have the unemployment boost. We're not going to have stimulus money anymore. We're not seeing stimulus checks. There's no talk of new stimulus checks. Sure, there's talk about maybe extending the child tax credit, but with this Congress, good luck. I don't see it happening. So in other words, what are we up against? I think we're potentially up against a lot of this funny money that's been helping prop up the market disappear by the beginning of 2022. And the market likes to be forward-looking. And so I've been trying to put together, why is it that right now we have all this inflation? There's literally a lot of inflation happening right now. Why is there so much inflation right now? But bond yields are going down, the dollar's going up, oil's going down, some commodities are going down. Basically, everything that says the market is expecting lower inflation to come is happening. And at the same time, the Fed's talking about tapering, which again, let me put it this way. When the Fed talks about tapering, okay, it puts less buying pressure on bonds. When there's buying pressure on bonds, prices go up and yields go down. If the market is expecting the Fed to stop buying bonds, then prices should fall. Because when the Fed stops buying, then there's less buying pressure, prices fall, and less people would want to buy now if prices are going to fall. Because they could buy later for less. But that's not what's happening right now. Bond prices are going up when we're expecting a lot of the buying pressure to go down soon. Which, let me put this a little bit differently, because I understand bonds are so complicated. It's complicated for me too. Okay, I'm not a bond expert. Let's say you are buying a house in a neighborhood, and you're like, oh my gosh, there are 5 houses on the market right now. All of them have multiple offers. Each house has 2 offers on it, so there are 10 offers on the market. Everything's going for 20 grand over the asking price. Do I want to buy now, or do I want to buy in December if I know there are going to be 3 offers instead of 10 on all of those different houses? So instead of 10 offers total, there are only 3. Way less buyers. It's kind of like the Fed exiting, right? Well, then I can be like, well, that would kind of imply that prices should go down in the future, in which case, why don't I just wait to buy then? But the market's not doing that. The market's like, no, we'll just buy right now anyway with bonds. And it's weird because that's what's actually driving bond yields down even more. People are rushing into bonds. So it's like, wait a minute, why? Why would you rush into bonds? You have to basically expect there to be deflation coming, or potentially even some form of a market pullback maybe a year from now, which potentially makes sense, the summer of 2020, because guess what? All the funny money's gone. Now all of a sudden, all the money that was propping up retail stocks and Apple and whatever other stocks, because people got all this extra stimulus money and all this extra discretionary income, all of a sudden that's all gone. People aren't getting this renewed check from the government. Now there's less spending. Now you're comparing 2022 comps, which we've talked about before, about a month ago on this channel. The comp comparison is going to be a disaster. You're going to compare 2022 sales at companies to 2021 when everybody had all their funny money to spend. That's not good. So you're now combining less money for people, disposable income for people in 2022, with all of a sudden valuations having to compare to a strong 2021, potentially setting up for deflation. So now we have to fight deflation with, wait a minute, if we fight deflation, maybe we don't have to raise interest rates and the Fed stays strong with keeping interest rates at zero. But wait a minute, people aren't getting money. And so all of a sudden the retail numbers are all too high and we still see a valuation reset of some sort. I'm trying to sort this all out myself because it's very complicated. I think the bottom line for me is, look, I want to be in this market, but I'm also not jumping up and down. You know, people are asking me regularly, like, oh, Kevin, we got another dip. You know, oh, look, charge point's getting close to those May lows where it was like $19 and now it's 23 or whatever, it's falling. We could just literally be in a bleed out year over the next year. If the market is indeed propped up by all the retail data that we got because people had all this extra discretionary income, disposable income, which they no longer will starting next year, which sets up for bad earnings next year. Now, everybody's talking about, oh, Q2 earnings. Honestly, I don't think anybody's going to care. I don't think Q2 earnings matter. What matters, in my opinion, is the market's perception of what's going to happen next year. And this is why I say it over and over again. This is sort of practical bottom lines here. Get out of call options. No call options. Owning call options. Now that doesn't mean you can't sell call options. Sure, yield farm, sell call options, sell put options, fine. But this belief here reiterates to me that, wait a minute, less money, less propped up earnings, valuations could potentially bleed out. It's kind of like think about, oh my gosh, like think about this. You know how with momentum stocks, we see them go whoop, straight up and then they kind of bleed out, right? It's usually not always straight back down. It's like a slow bleed out. What if in macro, a lot of the companies that we like investing in are just bleeding out? Like look at Tesla, for example. Apple totally traded sideways over the last year. Sure, they're doing better now. They're finally breaking out, but it makes you wonder, is that a sign of a flight to safety more than it's a sign that the market's not slowly kind of bleeding or going to bleed? What if the S&P 500 starts bleeding down? We'll see, obviously. I think earnings in this next section here could give us a little bit of guidance, because what's going to happen is, what's more important than Q2 numbers is actually going to be guidance. What are companies saying? Hey, we're starting to see things slow down. You know, if all companies are like, oh crap, things are slowing down, well, it makes sense why people are fleeing over to bonds. It's like, crap, nobody in stocks wants to hear slowdown. You get less derivative trading, you get less volume, less people interested in throwing money in the market, more people interested in holding cash. It's the same kind of bleed out that's happening in crypto. Less money, bleed out begins. Is crypto the sort of the beginning of this? And so where does it end? Because look, I'm not a doomsdayer, right? At least I don't think I am. I try to be very realistic. But, maybe 2020 was just the year of big, fat, massive gains. And the time between right now, February 2021, and now, summer of 2021, to the end of 2022 is just going to be sideways trading. I don't know. These are just some thoughts that I have right now and some concerns. So I want to hear from you. What do you think? These are just some things on my head or on my mind. Hey, let me know. Thanks for watching. All right. Bye, folks.